Right, I think we're good to begin. So, good morning, everyone. Welcome to Menzies Value Driven Reporting webinar this morning, coming to you from a very sunny South Coast. I hope everyone is keeping safe and well. My name is Phil Wright. I'm a director at Menzies in the outsourcing team. I'm pleased today to be joined by two of my colleagues, Oliver Finch, outsourcing partner, and here is popped up right on cue, and John Foundling, corporate finance partner too. Now, a little bit of housekeeping before we kick off. This webinar is going to be recorded for prosperity purposes, and if watching once and listening once isn't enough, you will also get a link via email after the session to watch again at your leisure. You're welcome to use the chat function for any questions, and obviously we'll do our best to cover. If we can't quite get to them all during the allotted time, then either myself, Oliver, or John will come back to you personally on your question. A bit of an idea of running order. So I will start off and we'll talk about high quality financial reporting for around 15-20 minutes. I'll pass the baton to Oliver. Oliver's going to talk to you about taking the information that we have there a step further in putting together best practice financial forecasts. And John Foundling is then going to tell us from a corporate finance perspective how that high quality management information and forecast either position the business really well leading up to a sales process, and actually how useful that information will be during the sales process too. So yeah, let's make a start. So I guess it's probably helpful to sort of position why we've sort of put management reporting and financial forecasting together. We're doing this because actually, when we're working with a business, when we're meeting a new business and we've started to understand the key drivers, understand the client, actually the two pieces of financial information we really want to see are, can we see your MI, and also can we see your forecast, and whether that's an independent financial forecast or part of a business plan, to be able to give us a good steer and be able to support the client going forward, trying to help them meet their financial aspirations. So some of this may be a little obvious for some of it may be new, but no doubt a good refresher anyway. So I guess before we end up with a high quality set of management accounts, we need to take this back a step or two. So the chart of accounts, also known as the general ledger structure, effectively is the listing of all the account codes of a business, and that's going to be everything from revenue, from direct costs, from overhead costs, and also all your balance sheet items, so your fixed assets, your current assets, your trade debtors, your cash, your stock, and all your liabilities too. So all of these come together and then become effectively the core information that then you prepare a P&L, a balance sheet from. But the bit we're trying to focus on, certainly in this part of the presentation, is around that distinction between direct costs and overheads. So, for example, the costs that are directly attributable or related to sales, whether that's sales of services or products, and then overhead costs, those costs that actually don't necessarily move in line with changes of turnover. And to bring it back to an example would be, if we had a business and we were looking at increasing turnover by £100,000 next month, what do we expect the costs associated with that £100,000 to be? How will they move forward as that business grows? Clearly, we don't expect overheads to move in the same fashion. What the directly attributable costs are there for that new revenue? And potentially, we could be in a situation where there aren't many. Maybe we have capacity in the business to accommodate that increase in turnover. Others may be more product-led, so there will always be an associated cost. What about cost of goods, labour, and things like that? So again, we're trying to think about that distinction and how it relates to turnover. And the whole point of both the management reporting section and also thinking about forecasts going forward is ultimately making sure that the client, the business owner or management team, actually understands the information available, understands the key drivers of value in their business, but also have that information in the right timescale, in the right fashion, to be able to make key business decisions moving forward based on high quality underlying data. So I guess moving on to try and bring this to life a little bit, here's a profit and loss account, slightly contrived, but actually the core is genuine from a client we started working on. And on the face of it, it looks sort of fairly sensible. I think we've got some sales, we've actually done some allocations of direct labour, we've got some staffing in there, we've got some subcontractors, and in a business where they are doing consultancy and selling licenses, again, we've got some licenses showing in cost of sales, and then some odds and sods from a miscellaneous expenses and sales commissions. Then, apart from some very small amount of bank interest, which actually probably isn't too bad considering where rates have sat over the last year, and then moving forward to operating expenses. So a long list of all the usual offenders you'd expect to see. And what we've done on the next slide is actually tried to think about a real life example here and where things have actually really changed, or rather where we've seen some real tweaks in our exercise. So first of all, we work with the client, and we're working on improving their management reporting, but also thinking about how that starts to support a forecast process. So again, we looked at salaries and actually worked with the client to think about the apportionment from people in their business. Who works on client delivery, who works on internal operations, who works on sales and marketing, etc. What we found was actually the salary split there in cost of sales was incorrect. People had been historically allocated, but weren't working in the same fashion. They may be 50-50, 75-25. So actually we need to think about on a monthly basis now how we allocate those salaries correctly against revenue to really give us a good steer of gross profit. You can see under operating expenses, we've got directors' remuneration. That's the two directors in this business. Actually, those directors still do revenue generating work. So all of their salary has been allocated to overheads, but some of the work they do is shown under income, under total income on the left-hand side. So again, an element of their time needs to be apportioned back. You can see just under directors' remuneration, employers' NI, 122,870. That is all the NI across the whole business. So again, there's a mismatch there where that's sitting and where it's been allocated. Some of that needs to move into direct cost. Subcontractors, you can see within cost of sales, 241,000, more than 50% was development spend. So they actually allocated all their subcontractors, whether they were overheads, whether they were development spend, or whether they were subcontracted for client delivery. Again, all under that same code. So some of that needed to come out. Software purchases, around 2/3 of the way down of operating expenses. Again, were all directly incurred in providing client services and products. Traveling, again, the very, very foot of operating expenses. The vast majority of that was, again, on-site, UK and overseas traveling for, again, client delivery. Some of it was business development, but some not. We can't see the gross profit margin, and actually we're struggling here, aren't we? We've got no comparative data, and we can't really understand from that information in isolation whether that return, 164,000, is good or not, in line with expectations. Should it be more? Should it be less? Would it have been higher in year ended 21 or 20? So again, we're talking about trying to think about the coding structure in our business. We're not saying there's any misallocations of the expense type. So those items in software purchases are genuine software purchases, but actually it's where it sits in line with your accounting structure and giving that true picture of what gross profit looks like. And again, because we're trying to understand when that revenue increases, hopefully moving forward, what are the associated costs and what are the associated return there. And from a general point around timeliness of management reporting, clearly here we are on the 5th of July and we're looking at a whole year's worth of data to March 2022 in isolation. And actually that is not on a timely basis and really then doesn't give us a good steer. How's Q1 22-23 gone, for example? So again, we need to be thinking about the period in which we report and making sure that information is timely and accurate. And again, on the next slide, we've got a sort of slight extreme case. So unfortunately, uninventively also called ABC Limited, but it is a different business. This client here is in manufacturing of a fresh product. And again, a bit of background on this one. So we started working with this client. We did some monthly management accounts, but actually there were some real changes in gross profit as a percentage month on month. This ranged from 25 to 33%. Sounds like only 8%. As you start to multiply that up to £4 million turnover, actually it ends up being a much bigger number. And the situation we were in here is from month to month, there were differences in cost of goods sold on these particular lines. You can see that there's about a dozen lines that make up a particular product. And what we couldn't understand was where movements had happened month on month when all of our cost of goods was just one line item. It's really tricky. What it actually meant was these £5,000 or £10,000 differences actually turned a profit into a loss. So rather than looking at this on a monthly basis, we took a step back and looked weekly. So there's a stock take. The client is moving forward with automation, but at the moment stock take is done on a weekly basis on a Friday. So actually over the course of a year, we built up a huge set of data by all of those cost of good lines, which then gave us a real steer as to what is our expectations and can we see anomalies in the data. So for example, when one particular line item tended to be between 6 and 7% turnover, and then one week it comes in at 11%, first of all, always checking in on pricing. Has something moved quite significantly? Or actually we'll be in a situation where there is an error, and potentially then there were errors around stock management and stock count and valuation. So again, breaking this down into a shorter time period gave us a real steer to be able to understand the key drivers here. And so from the client's perspective, it built up expectations for us and for them. So again, it's an extreme example of having to move to weekly reporting, but again, it was necessary to really be able to understand what's our makeup of gross profit again. So again, when we take on more work, when hopefully revenue increases, have we got the capacity to do this from a staff cost perspective? Would we expect to see staff costs increasing? And again, as a slight aside on this client, staff costs at times remained unchanged, whether they were producing £50,000-55,000 worth of output a week, or 60 or 65. So again, there's some real challenges around staff utilization. Is that being spent and managed wisely? So moving on to our next, just to sort of, I guess, recap on where we are with some of the key actions here of the first part of the presentation. So my sort of go-to would be review your current P&L. Are you happy that costs are allocated correctly? When was the last time this was reviewed? Has it always been like this? But potentially there have been some changes over the period. We may have added more products. We may have added services to our product offering or products to our services offering. So again, really look at the information that you have. Have we got costings right? Go back to our finance team. Think about whether allocations have been done correctly in recent periods. But challenge the management reporting pack. So the information that we have, is it up to date? Does it reflect our business now? Has it grown to a size over years potentially, where actually it becomes quite onerous? Have we got a real snapshot of business performance? Are all the pages reviewed by the management team? We have one situation where we're working with a finance manager, and the pack was quite unwieldy, up between 30 and 40 pages in the end. A lot of data, not a lot of graphics. And had the conversation and said, does the CEO look at the pack in full? And he said, I don't know. And then when we sat down with the CEO and we talked about the management reporting pack, we said, do you look at all the pages? No, it's just too much for me to get through. I really want a snapshot. Neither had spoken to each other. So one was spending an awful lot of time and getting a lot of pressure for how long the pack was taken to produce. But actually there was some information in there that probably could have been cut out or abbreviated. So again, when that person is reviewing that pack, and maybe it's a 15 minutes, half an hour a month, really quick review on the go, is there enough information there succinctly put to help them to understand business performance? What are the recent trends? What might that mean going forward? And finally, from a consistency perspective, one of the areas we would look at when we're going through the P&L and looking at that split between cost of goods, direct costs effectively, and overhead costs is, when you think about your pricing model, what costs are you including in arriving at that price? So again, it might be labour, raw materials, an element of consumables, potentially? Is there some travel elements in there? Is there hotels for overnight stays for staff? And then add in that profit margin back in. When you're then looking at your P&L, your reporting pack, are you seeing like for like? That sounds fairly obvious, but quite often it doesn't happen. So you've got this expectation from business owner of, we normally work at 40% gross profit margin, but actually management accounts are saying 30. A genuine example was a client in electronics where they had an operations director, and he used to prepare a report post month end of all the works orders that have been completed in the period, and the target was 35% gross margin for that order, and he would colour the works order green for hitting or exceeding the target and red for being below. So he would very proudly present to the MD his achievements for the month, and that would average out, say, for example, 36%. He's very happy. When the management accounts come out and they would discuss that around the senior management team table, that would range between 25 and 27%. So every time would always be, but I've made 36%. Where's the difference? So again, he wasn't comparing, or they weren't comparing like for like. There were elements that he'd missed out of his calculations that were included in the accounts. Equally, from the account side of things, had to work through a reconciliation to try and justify those numbers. So that real inconsistency meant they detracted from what they were trying to achieve and spent a lot of time trying to dissect the numbers. It's a good time, and actually in the end they were brought together, and actually what it meant was some reports from the accounting system were used by operations and vice versa, and actually arrived at a number that was within spitting distance. For example, incorrect labour rates being used, lack of appreciation for consumables, things like that. So there are occasions that we see where there is a real inconsistency in the mirroring of cost of sales against the pricing model. So I'd really encourage you to think about that and make sure you're seeing like for like, again, in line with your expectations. So I guess from the next sort of phase of this is, right, we have a situation where we're looking to improve our reporting. We've got to a situation where we've thought about our cost allocation between direct costs and overheads. But the real key to break down the numbers further, to give people much better insight, and this is twofold again. One, to really improve the value of reporting and understanding of the past and the trends and what this means for current business performance, but also a foundation going forward for forecasting. So we've allocated costs between direct and overhead, but the key now is to break that down further. How do we think about our business? Do we have a number of departments? Do we have a number of products or services? Do we work in different industries? Can we see that information by customer? Certainly from a construction business, maybe by project. So using this departmental structure, and some of you may be familiar, if any of you guys are on Xero, there's tracking categories. It's what Xero sort of terms departments. So again, breaking this down into how you view the business is really, really important, certainly from a revenue perspective, and then importantly from a cost perspective, to trying to directly allocate costs against this mixture of products, services, industries, projects, etc. This is going to give us some improved usefulness of the MI. We're really going to be able to understand our business performance. We can see underperforming business units, but actually what this might mean is it's our first real cut at seeing what is the results, what is the gross margin by income stream. Did I know that? What was my expectations? At the sort of outset, it might be that it's just a gathering of data. How does this move over the period? And what's really important here is that we start to pull out differing business units, differing results by business unit that at the moment are all amalgamated into one number. Now, one sales line, potentially several lines of direct cost, but coming back to one gross profit margin. Again, we might have a situation where we have a 25% gross margin, and we send some management accounts around to the board or sent to the bank, and the margin is down to 20%. And the question would be, what happened? Without breaking down revenue, without breaking down associated direct costs, we're really going to struggle to answer that question. But we're also using this as something to highlight anomalies. As we said in our example for the manufacturer, actually, this is a really good tool to look at our reporting. Is this right? It might be wrong. actually, but it gives us a direction, gives us a starting point. Should we be really allocating costs in that fashion? How's our apportionment of labour costs changing month on month, for example? What it might do also is to improve accountability. So there might be individuals in your business that actually have responsibility or P&L responsibility for certain functions, certain departments. And again, so you can break down this total P&L at the top level, potentially that the senior team see, but also cascade that down to other people in your organisation, maybe just down to gross profit. Also, it gives an opportunity to think about budgeting. So you might be able to set budgets, for example, again, by income stream down to gross profit, potentially if you don't want others to see the full financials. Although we're thinking about breaking down by revenue, we can also use the same tool to think about cost centers. For example, I've got a client in a wholesale business, but actually a big cost is transportation. So somebody has transportation responsibility. So they're looking at fuel costs, they're looking at repairs and maintenance, tax, vehicle insurance, and they have a budget to work to for the year. Again, they see a part of the overall financial picture, but it's relevant to them. Again, it can be helpful from one-off costs. So we've got a client at the moment who is going through a quite substantial website improvement exercise. And again, that's taking some subcontract costs and using a lot of internal labour as well to support with content. So again, they want to really understand what the overall costs of that website or exercise might be. So again, think about how you may want to use that departmental structure, not just for revenue generating items, but also for costs. So we used an example earlier on this particular business, and now we've fine-tuned our reporting a little bit, which is helpful. So we've managed to think about our revenue and break that down by consulting, products and support, but actually within those headings there are different characteristics of consulting we may provide to clients, and the same for products and support. So on the next slide, again, there's some areas for further focus. So we talked about directors doing some work on particularly or client delivery work. So again, you can see on here in that first consulting column here, actually the gross profit margin across our 3 consulting areas ranges between 13 and 64. And the one with the lowest margin is actually where the majority of our directors' time is being spent. Is that correct? Have we got the allocation right? Are directors working on a particular type of consulting? Is it project work? Is it retainer work? Is it work they've had for a long time and actually the right level? It needs to be questioned. We really got to think about there. Can we try and move that forward and think about a bit more as whether that allocation is correct. Products, you can see, as you'd normally expect to see products being quite high from a gross margin perspective, with low direct cost being associated. I mean, you can see here 84 and 76. They really are bringing that overall gross margin up, and the consultancy time in certain areas they're bringing it down. Support time is consistent. We're also trying to highlight some areas here of, so hosting we have in consulting, is that right? Is that really in the right space? Would we expect to see hosting potentially under product? Look, travel costs on product, is that allocated correctly? Is there further sales commissions potentially to break down? And also we've got another column in here with quite a substantial value around sort of 1/6 of revenue in there for the period being allocated to other. Do we need to break that down further? Naturally, worryingly, that other column is one of the lower gross profit margin areas. So again, something to think about a bit further. But really what we're trying to understand here is give us a real mechanism to review, to check the information we have, and really from a business owner's perspective, are these results in line with the expectations, the gut feel we have for the business? I'm conscious of time, so I'm just going to move a little bit swiftly on to the next slide. So one of the areas, again, it's really, really important to consider is key performance indicators. So what we're trying to get to when we're helping a client put together their management pack, we're almost moving management reporting on a step to management information, or management accounts to management information. It shouldn't just be a simple P&L and a balance sheet. There's extra information in there that quite often, or more often than not, comes from outside of finance. So we're thinking about, is there a real dashboard and overarching summary of business performance in the period that gives some key financial data, some information around sales and marketing. So we might be thinking about quotations. What's our quotation conversion rate? We might be thinking about what's our pipeline. So actually our potential for the future may be quite significant. If we've had a downturn, say in the last month or quarter, we may be in a position where actually our pipeline is strongest it's ever been, but we don't see that obviously in our historic financials, but needs to be taken into account. I think where we're, I guess, on a journey of starting to add in some key performance indicators across any sector, we'll be looking at gross profit margin, net profit margins, and looking at our general percentage of revenue across our key direct costs. But again, from a few here that we should talk through, from a software perspective, annual recurring revenue is really important to think about the sort of Netflix model. What's my sort of run rate of customers? Who do I have as subscriptions, and what's my churn rate? How often they turn over? The better, the more customers we have, the better the annual recurring revenue. The lower the churn rate, again, is a key driver of business, or key business driver rather, in a software business. Professional services, we're thinking a lot around staffing, so a lot around chargeability, work performed on client matters, and billable hours, whether that is accountants, lawyers, people in marketing, or any kind of business where you're working on hourly rates potentially, or fixed cost. So then we'll be thinking about profit and loss by project. What information do we have from the profit or loss on a project to help us think about quoting moving forward? From a hospitality and leisure business, maybe thinking about revenue per customer if we're thinking about restaurants or bars or pubs. And then from a hotel perspective, average room rate, what's our occupancy percentage? How many rooms we have available? And actually our revenue there is a function of the three. And manufacturing is an area that I spend quite a lot of time in. And yes, we're looking at cost of goods as a percentage of revenue and really trying to understand the makeup. But also we're looking at labour, potentially labour as a percentage of revenue, how that moves, what's that relationship, our labour and machine hours utilisation. So again, we're thinking about what's the capacity in our business, and going forward, as we add revenue, where do we think that that growth in costs associated with that revenue may come. So finally, I'm conscious to wrap up. So key takeaways from this section. To review your structure, really think about the structure of your management reporting, management information that you have, what's right for you in your sector, and what's right for the people that receive that information, and also how long that information has been coming out to you in that same sort of structure. So always helpful to have a bit of a refresh. Is it timely? If we're a business, we're looking at the spot rate, so we are buying and selling at market prices. Having that information really quickly after month end is crucial for planning. If we're waiting nearly 30 days, we've almost missed the next month. So again, making sure the information is accurate, making sure that we don't have any weird and wonderful accounting policies in there, and making sure the information's useful, it's succinct, it's being delivered in the way we intend it, and also that from a senior team that are reviewing this, is it suitable? Is it a quick snapshot? Is it a dashboard, as we said earlier on, maybe that just highlights some key financials? How are we interpreting the data? Who's helping us support and giving us the insight? What do we do with that information? What does it mean? What are they telling us? What are the trends over time that are really dictating what the future may look like? So we use the output for planning. We really want to be able to see how the information to date gives us a steer for what might be on the horizon. So again, we're really looking at trend analysis. What trajectory are we on for our business? What might that mean for the future? And then we home in on how do we improve in profitability. We're looking at that breakdown of revenue by business unit, by product, project, service, and look at underperforming units. Is that in line with our expectations? How do we pull this up? How do we improve our gross margin? So again, that leads nicely on to forecasting and where the key drivers of value are for the business in the event of a sale. So finally for me, we've got a quick poll. I'll be very grateful, ably supported by Helena, to run for us. If you kindly answer this question, I'd hope to sort of interpret the answers, but I've run over time a little bit. So what we'll do is we'll review this internally and then come back to you guys individually. Are we all done? Right, we'll close the poll. Thank you very much. Okay, so a reasonable spread on those. Yeah, okay, let me sort of digest those results, and I'll come back to the guys that have kindly complete the poll and after the event. So without further ado, passing on to Oliver to talk to you about financial forecasting. So thank you.
Thanks, Phil. As Phil said at the start, my name is Oliver Finch. I'm the partner of outsourcing and systems advisory at Menzies. Phil's spoken obviously a lot there about reporting the KPIs and getting the underlying data and allocations all correct. And in doing that, you have lots of information to show you how the business is performing now and how it's performed over time. I want to take it from there and talk about forecasting and how you use this data and the detail to look ahead. So forecasting is so beneficial for businesses for many reasons, but it's not used very often in our experience. We find a lot of businesses do not have forecasts or budgets in place, and this is for a number of reasons. People are not always sure where to start or are worried about the consequences of getting it wrong, or are put off as it seems very technical. It seems people can be nervous of it, as it can be quite daunting. But I want to run through some of the methodology and the benefits of forecasting and try to encourage more people to consider it and try to overcome some of those concerns. I'm not going to say that it's straightforward, but it can be simple. It all depends on the business or how specific you need that forecast to be. You could just roll forward the current trends, for example, or you could add 5% growth across the board and see how that looks. It's a starting point and it gets you thinking, it gets you talking. But obviously it can also be complex, of course. You may need something really detailed that needs to stand up to scrutiny from a bank or investor or due diligence for a sale, perhaps. All of these would require a lot more input on nearly every line, documenting all the assumptions and building up a really robust forecast. What we're saying is that there are levels. It can be really complex for specific purposes, but can also be simpler to be able to be kept up to date more frequently and used as a method of keeping on top of cash flow. It's an extension of the reporting, really. Once you have everything Phil's mentioned in place with accurate data and income and costs all going to the right places with the various KPIs being produced, then the forecast should follow on nicely in the same format and should be easier to maintain and be more useful. You ultimately take the reporting line by line and think about the future. What are your expectations in the future for sales, for the various costs and growth, for example? Obviously, no one knows for certain, but it's all just having a go and having a sort of realistic view of what's coming. Do you have any large expenditure coming up, like recruitment or machinery, for example? And even without getting into the actual forecasting, it's quite a good exercise and focuses your mind on the future and what might be coming around the corner. But by looking into the future, you can see how the business could perform and the impact on cash. It can really help with the decision making, for example, when to start that recruitment for the growth, or when you can expect to be able to afford to buy that machinery. It can be very powerful, setting targets too. You can set out where you would like the business to be, and then how you and your teams can achieve that goal. Using various KPIs as the measures for success, you can set targets for staff based on the main drivers for those KPIs. If everyone's focused on the areas that they can influence, that will then help the business achieve its overall goal. I want to talk now about three-way forecasting. This is something that's extremely useful for a business. I mentioned that forecasting can be daunting, but when you throw a phrase like three-way forecasting out there, it makes it sound even more complex. It shouldn't be though. In reality, it's the three financial statements on the screen, all linked together. With a good spreadsheet or forecasting software, a lot of the hard work can be done for you, and you can focus on the results, which can be extremely powerful. As mentioned before, it's an extension of the normal management information that you should receive. This forecasting model predicts the future performance through your profit and loss. It looks at how the future balance sheets will look as a result of those expectations, and most usefully, how the cash balance will change over time. This method takes the timing of cash flows from around the business into account to predict the movement over time, depending on when they may land. Some big examples are your VAT being paid quarterly. That's often a really big chunk of cash that needs to be paid every 3 months and can come as a surprise and really dent your bank balance if you're not prepared. You will also have customers paying you at different times. Your terms may be 30 days after invoices are issued, but in reality, we all know that not everyone sticks to those. With a lot of customers probably paying on 40, 45 days or more. And this can have a huge impact on cash. You can be really detailed to map out those customer trends and then see how the small changes in your debtor days will impact your cash. You can then focus on specific customers to make really big improvements. With three-way forecasting, you should be able to visualize the three financial statements as well as your KPIs and see when those key milestones are expected to occur and what could be done to get there sooner. This moves us on to scenario planning. Put more simply, this is what-if analysis. What is the impact on the business if we do this or if we do that? Once you have the forecast all in place, you can then play around with it by tweaking certain areas and seeing what it does to your KPIs and your cash. These areas to tweak are the assumptions and drivers which influence your KPIs. Based on some of the industries in the audience today, I'll run through a couple of examples just to get some thoughts going on what may work for you. Starting with services, there are lots of examples of that on here today. You may be considering recruiting into a fairly senior position. How would that look? You'd have all sorts to consider: salary costs, the tax and NI, pensions, etc. You've got the recruitment cost, which can be quite chunky, and upfront hardware, software, maybe furniture. How long would that individual take to get up to speed? When would they get to the level of productivity you need? Is the work already there for them, or will they need to go and generate it themselves? It will not generally be the case. A new person will straight away generate 100 grand turnover from day one. So the additional revenue will need to be staggered over time. There's also the impact on the rest of the business. On a positive note, it can free up your time to spend on strategic matters or business development and speed up the resulting growth. But it may not all be positive. There may be a potential negative impact to consider. So what if we hire this new person, but actually then this person over here gets disgruntled and leaves as a result? Could we or should we therefore wait for the existing team to come through and recruit at the bottom? And what would that look like? Another example is manufacturing. What if we purchase a new machine, and which one should we go for? If we go for machine A, it provides X number of machine hours and requires Y hours of labor, whereas machine B provides more machine hours, produces more items, but requires more staff time to keep it working. And also its maintenance contract and support contract costs are more too. These factors can all be plugged into the model and extrapolated over time to see how soon until the payback is expected, but also how much additional revenue and at what margin can be generated in the long-term future. In most forecast software, you can toggle these on and off. So you can have your base forecast and then you can turn it on, turn it off, or maybe change some of the percentages involved and just see how that moves things over time. So these are all examples of the types of what-if scenarios that we can expect, but you can use this method for any decision really. Some will be quite straightforward, but some will require a lot of thinking to make sure you consider all the angles. This is where three-way forecasting not only helps with that initial brainstorming process by visualizing all components of the financial statements, but also shows you the impact on each too. So hiring that new employee could increase revenue by a certain amount over the next 3 months, for example. But if all the costs involved mean cash flow is poor and you can't make your next tax payment to HMRC, then perhaps you should wait until the tax is paid. And you've got a while then before the next payment to get them up and running and generating the right turnover and margins to have that cash flow back again. The last part on forecasting I'd like to touch on is the benefits. First one is related to how you can build and maintain your forecast. And there's a number of ways, all with their own benefits. So software-wise, you can start with Excel. It's the classic way of doing things. It's what the majority of people are comfortable using because they can understand it and you can make it do pretty much everything that you need to do. It's easily accessible and most people can follow it through if it's shared. A good forecasting model set up on Excel can be excellent. However, it does come with some warnings. It can take a long time to create and to adjust. Everything needs to be correctly linked to formula from the start, and that needs methodically putting together and mapping. The adjustments are manual. Every time you change or add something, it will need rechecking and remapping through all the tabs and everywhere else that the information is. And scenario planning can be tricky to turn on and off. The forecast can go wrong easily. There's a huge human error risk. Big decisions will be made on that data, and one incorrect cell somewhere in amongst all the information and the data and the tabs, that can make it totally unreliable. There's also other very bespoke software, quite expensive software out there that does a great job for very complex forecast, generally used for like the one-off exercises for funding or investment, for example. But that's very good at what it does, but like I say, very expensive. Then there's the new sort of cloud software, which is in the market. This is much much cheaper, but it's on a sort of a subscription basis, much like your CRO and your QuickBooks. And there's many apps on the market that will sync automatically to those accounting software, the Xero and QuickBooks, and they will produce a three-way forecast almost immediately. You press the button to sync, and it does all the work for you. They take the trends from your recent actual accounting data to predict the levels and timing of future revenue and expenditure, and ultimately the cash flow. And they'll do probably about 90% of the work for you instantly. And then you can tidy them up with your assumptions, expectations, scenario planning, and give a really good view of how the future may look. Some of our favorites, just to mention, are Fathom, Futurely Predict, and Fluidly. Fathom is particularly good as it combines the detailed reporting, much in the same way that Phil was talking about earlier, really detailed reporting with three-way forecasting. Other benefits are with the staff in the business. It doesn't have to be something, forecasting doesn't have to be something that's just for the accountant or the business owner. It can be a good opportunity to include staff from around the business. When considering the drivers for the key performance indicators, it can often be the people in the team closer to the service or process that have the deeper understanding of what's actually happening and what the team or the machinery should be capable of. They'll probably give really good insight when considering scenario planning too. So involving key members of staff should give them a real sense of empowerment too, that they're contributing, and what they and their team really does matter and makes a difference. They can see exactly how they fit in and how they can help achieve the goals of the business. They can then take that back to their teams and focus everyone on the things that matter. Forecasts can be used for setting targets, both for the business, but also for the staff. When you know where you want to be in the future, and there are clear drivers to achieve that success, then you can incentivize staff to help you get there. By setting targets based on the areas that people can influence, then people understand the impact they can have and the part they can play to achieve success. By all working together on the important areas, the business continues to move in the right direction. It improves its key performance indicators over time to be the best it can be. It demonstrates the profitability, builds value, and it moves towards its long-term goals, sale, for example. By having all the right reporting measures in place and the forecasting to aid the decisions and set targets, you can build the value and be really attractive when the time is right for sale. John, one of our corporate finance presenters, he'll be speaking a lot more on that next. But before he does, we want to have just another quick poll, this time around your attitude towards forecasting. We can put that up on the screen. If you don't mind, just answering that question, just to see where the majority of people are with forecasting. And like Phil, we won't run through the results due to time, but we'll pick up on it and we can look at it afterwards. Okay, I think we'll close that now. Thank you very much for everyone that's put in there. Just very briefly, yeah, kind of as expected, that's good. Excellent. Thank you very much. I'll just pass you over to John.
So thanks, Oliver. Good morning, everybody. Trust you're enjoying the webinar so far. I think it's fascinating to have that deep dive into reporting and then to see the link back into forecasting. Now, I'm going to start to talk to you about how this links back in with driving real value in your business when it comes to exiting the business. So if we can move to the next slide. The exit considerations, where's the value of all this reporting and all this information? So the key thing is that when you come to sell your business, to exit the business, you are going to be presenting the business to a third party, and you want to present it in absolutely the best light. And what you need to have, therefore, is comprehensive information, which this financial reporting and the forecasting will enable you to have. Now, the whole ability to be able to consider the history is the perfect link to support the forecasting going forwards. And obviously what you're able to do in presenting to a third party with all of the information that you have is to demonstrate the strength of the business. We've been talking about how you can link in your KPIs and focus on different projects, different products, and different divisions within the business or business units. And being able to differentiate and to present the real strength of your business is tremendously helpful in that exit process, and will certainly enable you to drive the value of the business. Now, when you come to an exit process, there is always going to be due diligence from the purchasers of the business, and that is a significant part of the process, which involves reviewing lots of detailed information. And then as we get towards the end of the process, and I will talk you through a typical process in a moment, an important part of this is going to be focusing on the working capital of the business. Now, if you've already been preparing your reporting on a regular basis and considering your working capital, you will already have well-managed working capital, but it's still a case of being able to understand your working capital when we come into the final parts of the process. So let's talk about what the typical process is. A typical process when you come to sell the business, the first thing you're going to do is to prepare what is called an information memorandum, which is quite a detailed document to enable the buyer to understand the business, to see the strengths of it, and to be able to make an offer for the business. To do that, you would need to prepare detailed financial information, as well as obviously an overview of the business in terms of what it does, who's involved with the business, what the strategy has been. So the historic financial information is absolutely critical in this because it demonstrates the historic growth, and hopefully that links back into the future growth that you're forecasting for the business. But in addition to that, we can drill down into the detail, which means being able to analyze customers, to understand that margin mix between projects and products, etc. And just linking back in with your key performance indicators. If it's a software business, we're talking about the recurring revenues, the churn rates. We talked about hospitality earlier, and that's occupancy rates. And what you should be able to demonstrate is progress across a period. So you're looking at kind of the past, you're looking into the future, and you're showing the real strength of the business, enabling a purchaser to understand that strength. Now, once you've prepared that information memorandum, you approach buyers, you obtain offers, then you get to the point where actually you agree with a single purchaser, you agree a period of exclusivity with them through a heads of agreement, setting out the details of a deal that you've agreed. And then you move into the final phases of a deal. And the next phase, onto the next slide, is the financial and legal due diligence. And the financial and legal due diligence is basically the purchasers checking everything that you've told them and reviewing all of the information, getting comfortable with what they are buying. Now, you do this by using a virtual data room, and there is significant data that you will need to collate to provide to the purchaser, potentially for the last 3 years, the current financial information, the forecast, etc. So there's plenty of information. Now, as part of that, you will need the monthly profit and loss accounts and balance sheet figures to enable the buyer to carry out their own analysis as well. Now, obviously, what they will be doing is, if we prepared some analysis in presenting the business and showing them the strengths, is reviewing that for themselves as well and getting comfortable, and just getting more and more comfortable by reviewing the data and confirming what we've already told them and what we've presented to them. That then drives you into the final negotiations. And we'll come on specifically to that in due course, but there's this whole process of looking at the working capital of the business, making sure that we don't leave value on the table as we kind of get to the final conclusions of a transaction. That drives you into agreeing the final share purchase agreement, which is the legal document for the sale of the shares in the business. And obviously there's a disclosure process against warranties, and having the detailed data enables you to reference back to the data that you've got in the data room. And that will help you to be able to manage then the risk going forward, so that once you've sold the business, you will generally be able to if you are walking away, just walk away and enjoy your future without the business. And obviously this drives you through to that final completion point, and often everybody gets together and there's a completion meeting, perhaps in a room. Sometimes these days they've been virtual over the period of the pandemic, but inevitably you kind of pop the champagne corks and everybody's very happy. But it comes about as a result of that hard work that you've put into building the business, understanding the business through the financial reporting, focusing on what the future looks like and being able to predict that future with some accuracy because you've got better and better at it as you've gone along. And then being able to provide that detailed information to support the purchase process and to help the buyers to get very comfortable with the business. Now, if we come back to kind of the fundamentals, let's just talk about perhaps the key question you're all thinking, well, what's my business worth then? So how do you value a business? For an SME, the key way to value the business is to think about the normalized or underlying EBITDA times a multiple. Now, let me just explain EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. And that amortization is effectively is the writing off of goodwill over a period. And really what EBITDA equates to is it's a kind of a proxy for the cash generation by the business. And it's an important measure when you're looking at purchasing a business, when you're looking at selling a business. Now, EBITDA could then be adjusted for capital expenditure. If you've got a business where capital expenditure is mission critical, you've got to keep your manufacturing kit up to date and you're renewing kit, or whether you're renewing vehicles or whatever it might be, there could be an adjustment for regular capital expenditure to that underlying EBITDA. But what do we mean by normalized? Because we did say normalized. Well, in that first example that Phil gave earlier on, we saw a business generating £2.33 million of turnover. And I think the director's remuneration that was being showed to us at that point in time was 260,000. I guess if you take into account the national insurance, that's close to 300,000. Well, actually, let's suppose that is too high a figure. Then we need to adjust the profit back up by saying, okay, only one of the directors is needed, or they're paid twice the market rate. Then we'll be making an adjustment to that. And suddenly then the return on sales is going to increase substantially. Now, if we were to add back half of that, I think we'd receive the return on sales growing from something like 7%, because it was generating 163,000 of profit, right up to kind of 13.5%. Now, of course, if neither of the directors was required, I think they probably are in that instance, but if neither of the directors are required, we then see the kind of the profit jumping to 19.2% of sales, which is a phenomenal result. Now, getting the add backs right is really important. So what those add backs might be, apart from adjusting for directors' salaries so that they genuinely reflect market rates, the other things that you'd be looking for would be one-off non-recurring costs, something that's a cost that's not going to be there for the purchaser post-acquisition. And therefore, what we're looking at is the underlying profit that the purchaser is going to acquire. Now, having the right reporting data will enable us to isolate that information. Having the right monthly management accounts will remember what those costs are, what they related to, and therefore why they can be and should be added back. And therefore, the data will be verifiable during the due diligence process, and it will help just to underpin the value that you get for the business. Now, the second half of the equation, of course, is the multiple. And the multiple effectively depends on risk and the growth prospects of the business. If we could move to the next slide, please. Points to think about in relation to the multiple itself. Clearly, if you've got a business that's declining, the multiple that you apply to generate the valuation is going to be lower than if you have a business that's in a high growth mode, where the multiple is going to be much higher. So there are some things that we know about these multiples just intuitively, and all of us can kind of understand them. There can be sector considerations. We know that in technology businesses, these multiples can be extremely high, and sometimes they can be delinked, in fact, for valuation purposes from EBITDA back to turnover, although frankly, it still can be calculated as a measure of EBITDA. It's just that the multiples will be so much higher. So the historic performance is important, and obviously that value is going to be driven by those historic reporting analysis that you can provide. Forecasting the growth. Well, if you're forecasting a position which is just stable, then that might generate you one valuation. But if you are forecasting growth and you can demonstrate that you've achieved that growth in the past and you're clear what's driving that growth, then that's going to help you again with the multiple and can help you with the underlying value. The key performance indicators that we talked about earlier are also going to help you. And because they're going to help you to be able to demonstrate the strength of the business and the fact that the risk that is perceived to be within the business, you've driven that out already through the regular review of your reporting and through thinking about your forecasting. And as a consequence of that, the multiple will be higher. So the value-driven reporting and forecasting is a really important part of being prepared for sale. Now, the management accounts and the analytical review that you complete is just going to support us in terms of where we get to with this multiple of EBITDA. If you've got high level of customer concentration, again, the multiple may be lower than if you've got a good spread of customers. So there's lots of things to take into account here, but they're the fundamentals. The first fundamental that we talk about is effectively there is normalized underlying EBITDA times a multiple. Now, the next thing that I want to come on and just to kind of to pick up is the back end of that process, because the second fundamental is that transactions, the vast majority of transactions, that they're based on a debt-free, cash-free basis, subject to a normal level of working capital. Now, the debt-free, cash-free, I'm sure we can get our heads around, not just bank debt, but obviously accrued tax at the point of disposal. The cash-free element, if you've got surplus cash sitting in the business, but again, we can kind of understand what that is. But what's the normal level of working capital? Well, the answer, it's a difficult question to answer, but it depends on the historic position. And the key thing to remember here is that it's going to be calculated by reference to the last 12 months detailed balance sheets. So the work that you're doing with Phil and with Oliver and with the outsourcing team is going to give you the information that you need so that we can drill down and actually understand the last 12 months balance sheets. But we are going to have to adjust it for any abnormal items. So let's just say that you've got a customer, they owe £100,000, they're usually on 30-day terms. You then decide, because they're an important customer to you and they ask you, that you're going to allow them to have 120 days to pay on this particular occasion as a one-off. Well, there will be a distortion to the working capital on an average basis over that 12 months of 25,000. That could be 25,000 that you leave on the table if you haven't got that information. So hence it's important to have the drill down information and to be able to understand what's happened. It could be that what you've had is supply chain issues, and therefore you've had a short period of holding high levels of stock, and we want to make an adjustment for that. It could be that there's been a change in suppliers because of supply chain issues, and you ended up with different terms, and the terms are better. Well, then we want to make an adjustment for that as well. Ideally, it's better to have more than 12 months to be able to consider the position, because 12 months sometimes is just a snapshot, a period, and you could say that actually in the last 12 months, John, our business has changed substantially, and therefore to be able to demonstrate that, what we may want to do going through a period of change is to come back to kind of what it looked like previously, and therefore to review a longer period so that the adjustments that we make sense and can help us to present the business in the strongest light so that we don't leave money on the table. Now, obviously the management reporting, management accounts and reporting pack are just incredibly helpful with this process, because the narrative and the numbers will help us to understand the adjustments that we need to make. So what we'll be doing is all the things that we were talking about earlier, which is reviewing, challenging, looking for the consistency. But where's the value then? The value in this whole process of value-driven reporting and forecasting is when you come to exit, you'll be presenting your business to a third party. The history is likely to underpin your forecast going forwards. The history and the reporting will enable you to demonstrate the strength of your business. Don't forget that the due diligence process, it's a big paper chase. There's lots of information that will need to be reviewed. And that final piece, it's easy for people to overlook this, but don't leave money on the table. It's about negotiating the working capital position. So genuinely preparing good management accounting, not only does it help you to plan and to kind of to review and to grow your business, it will help you to deliver real value when you come to exit your business. So let me just pass you back to Oliver now, who will wrap up our seminar, our webinar for this morning. Thank you very much.
So we did have a question just before as well, just sent in advance. So if we'll run through that just briefly whilst we're on that. So yeah, there was one in advance. Just someone was interested to know about how best to measure customer acquisition costs in a business. In a business that doesn't have much marketing spend, so which costs should or should not be included. So we've had a think about that, and we've taken this as sort of capturing the costs related to building a customer base. So it could be related to prospecting time and networking, client entertaining, travel, an apportionment maybe of rates, and the cost of a desk. So there's lots to probably consider in that, and how detailed you want to be and sort of really going down on what sort of granular level you want to get to. But it all comes down to how you split the time and costs out with some level of accuracy, really. So with little marketing spend, we assume it's a people business. So the larger cost will probably be the sales personnel or the chargeable staff maybe doing that business development. In that case, it could be allocating the time cost to a cost center and understanding the relationship between the spend being allocated and maybe conversion stats. So giving an average cost per customer acquired across the period. Or if the projects are sizable enough, then project open up for each to really sort of allocate the costs and individuals to the different areas. You may or may not use timesheets. You know, we use timesheets here. Not everyone likes filling them out. It's not everyone's favorite thing every week, but they do give really valuable data, particularly when you're looking at people's time and the cost element of it, because you can see exactly where people are spending all their time and what parts are going down towards that business development or marketing. And then obviously you can split the cost element out based on percentages, and you know, you've got something that really supports it then as well. You know, it's not just sort of saying, okay, this guy over here spends maybe a day a week or 20% of his time on that area. You can really see exactly what's being spent, and maybe set targets on it again. But you know, it then supports, you've got something there to support that time associated to winning the new business. Okay. Yeah, I don't think we've got any more coming through. If anyone does have any more questions, then please feel free to get in touch. Or if you want to talk about anything that we've spoken about today, then please get in touch. Otherwise, apologies for the technical error at the end there, but thank you all for joining, and we'll speak to you soon.